everyone, this is Liu and I'm going to talk about the research that I did for acquisition and the outlook of the acquisition in this presentation. First, I'm going to introduce the acquiring company, which is a National Australia Bank. It is the largest business bank in Australia, and the main service is saving account, term deposit, and the law. And it provides service in Australia, New Zealand, Asia, United States, and the United Kingdom. The market value is 76.4 billion. Overall, the banking industry is in growth phase. The first reason is the total GDP increased from 2017, and also it has an increased interest rate which can charge higher from the borrower. And next, I'm going to introduce the target firm, which is Marvick. The main service of Marvick, it is a leading diversified Australia property group and owns and manages assets across the office, retail, industry, and sectors. The market value is 8.35 billions, and it only provides service in Australia. The property industry is in growth phase. The first reason is a global economic growth increased the house price, and also there are a lot of industrial land converts to residential purpose. And however, the household debt has escalated with the house price. So next we are going to calculate the discount rate. We choose to use the WACC as the discount rate. The first we need to calculate is the cost of equity. From this graph, we can see the cost of equity is 6.64% after calculation. And next, we are going to talk about the cost of debts. We choose to use the risk-free plus the spread rate. From this graph, we can see the cost of debt is 3.24%, and the market value of equity is 15.34 billion, and the market value of debt is equals to the book value, which is 3.15 billions, and the WACC is 5.89%. And the valuation method we choose to use is a DCF model, and there are some assumptions. The first one is a time horizon. For the next 5 years, we assume that there are higher growth rate, and after 5 years, there will be a stable level. And the discount rate is a WACC, which equals to 5.89%. And the next, we need to calculate the growth rate. We choose to use this formula to calculate the growth rate. From this graph, we can see the ROE is the dividend payout ratio of MGR, so the growth rate is 4.1%. And the next, we need to calculate the free cash flow of Marvick. We choose to use this formula to calculate the free cash flow. And there are some assumptions of the growth rate. From this graph, we can see the revenue growth rate after the 5 years is 50%. From the next 5 years, 15%, and after 5 years, 4.1%. And since there are two stage of the growth, so there are two formula that we need to use to calculate the valuation. From this graph, we can see after calculation, the valuation is 13.4 billion. And the next we need to do is relative valuation model. We choose 7 of the similar market capital in property industry, and the median EV EBITDA is 15.34. So the enterprise valuation is after calculation is 70.3 billion. And the next we need to do is sensitivity analysis, which is to analysis revenues growth and EBITDA margin growth. From these two graphs, we can see that the valuation is more sensitivity to the EBITDA margin rather than the revenue growth. Next, I'm going to talk about why this is an attractive investment. First of all, this company is undervalued firm, and it also have the profitability. For the financial leverage situation, it has higher interest coverage ratio, and after margin, it also will provide the synergy gains in this margin. For this margin, it is a vertical margin. The first reason is Marvick is a property company which also have REITs. So the NAB can be the interbank and also can be an investment institution. They also can be the custodian bank of REITs. For the deal structure, we choose to use 7%, 70% cash and 30% stock. The reason is the cash of NAB is really high. It can increase its efficiency of cash usage, and it also can satisfy the need of shareholder of MGR who could be more conservative. However, the growth potential of stock price of NAB is also high. So we assume the takeover premium is 10%, so the purchase price will be 60.5 billion. So the deal structure will be 11 billion in cash and 4.9 billion in stock. There are also some regulatory issues. The first one is the Cooperation Act. This is mainly talk about the acquisition of control should be taken place in an efficient, competitive, and informed market. The next one is the Competition and Consumer Act, which is CCA, and it mainly talk about against the anti-competitive margin. For the target company, I think they will accept the offer. The first reason is that after merging, the share price usually will increase, and the Marvin can get a premium. They also have an advantage to negotiate with NAB for the retaining control in the companies after merger. For the market reaction, I think for the target firm, the share price will increase, and for the acquiring firm, in the short run, the stock price may decrease, but in the long run, there is a chance that the stock price will rise. Thank you.